The order button changed overnight. Major bullion dealers added minimum purchase thresholds. Some went to allocation mode. The spot price didn't crash, supply didn't vanish. But suddenly, you can't buy less than 10 ounces. This isn't a shortage. This is a hedge breaking in real time. In the next 17 minutes, you will understand why dealers impose minimum orders when volatility spikes. You will see the invisible hedging mechanism that protects their margins. You will learn why the spot price and the deliverable price are divorcing. You will discover the funding trap that turns inventory into liability. And you will understand why rationing appears not because metal is gone, but because risk became unmanageable. In a calm market, buying silver online is simple. You visit a dealer website. You see spot price plus a small premium. You add 1 ounce to cart, you pay. Metal ships in 3 days, the dealer holds inventory. They buy wholesale bars from refiners at spot plus a tiny markup. They sell retail coins at spot plus a slightly larger markup. The difference is their profit. This works because the dealer can hedge their inventory on the futures market. When they buy physical metal, they simultaneously short an equivalent amount of paper contracts. If spot drops, they lose on inventory but gain on the short. If spot rises, they gain on inventory but lose on the short. The net effect is zero. They lock in their margin and earn the spread risk-free. Settlement timing is predictable. Funding costs are stable. Volatility is low. The system hums along invisibly. But this equilibrium depends on one critical assumption. The hedge must stay cheap and accessible. The average retail buyer never sees this machinery. They assume the dealer simply owns a vault full of coins waiting to be boxed and shipped. The reality is far more complex. Most dealers operate on thin inventory buffers. They might hold 30 days of average sales volume. Anything beyond that ties up capital and incurs storage costs. The goal is velocity, not stockpiling. Buy from wholesaler. Hedge on futures, sell to customer. Ship, repeat. The cycle turns every few days. Cash flows in, metal flows out. Credit lines stay open. Margins stay predictable. This model works beautifully in stable conditions. But stability is the load-bearing assumption. When that assumption cracks, the entire structure wobbles. When volatility explodes, the hedging machine breaks in stages. Stage 1 is margin expansion. Futures exchanges raise the deposit required to hold a short position. If a dealer shorts one contract to hedge 5,000 ounces, and margin jumps from $12,000 to $25,000 overnight, the dealer must wire $13,000 in cash immediately. Multiply this across their entire inventory. A dealer holding 1 million ounces suddenly needs millions in additional collateral. Where does that cash come from? Not from sales. Sales take days to settle. The cash has to come from credit lines. But credit lines have limits, and here's the brutal part. The margin call doesn't care about your business model. It doesn't care that you're perfectly hedged. It only cares about volatility. The exchange sees wild price swings and assumes everyone is riskier, so everyone pays more. The dealer who hedged responsibly gets punished alongside the speculator who went naked long. This creates a perverse incentive. Why maintain a perfect hedge if the cost is the same as being unhedged? Some dealers start cutting corners. They hedge 70% instead of 100%. They gamble that the unhedged 30% won't move against them before they can sell it. This works until it doesn't. Stage 2 is spread blowout. When hedging becomes expensive, dealers widen the gap between bid and ask. Spot is $62. Normally they sell at $64 and buy back at $61. Now they sell at $68 and buy at $58. The spread protects them from the cost of maintaining the hedge. But here's the trap. Wider spreads attract fewer buyers. Fewer buyers means slower turnover. Slower turnover means inventory sits longer. Longer hold times increase funding costs. The dealer borrowed money to buy that inventory. Every day it sits unsold, interest accrues. The spread has to widen further to cover the extended holding period. This creates a doom loop. Wide spreads, slow sales. Slow sales require wider spreads. The dealer is stuck. But the spread isn't just about hedging cost. It's also about replacement uncertainty. In normal times, a dealer knows exactly what it costs to restock. They call their wholesaler. They get a quote. They lock in the price. Done. In volatile times, wholesalers stop giving firm quotes. They say, call back in an hour. Or they say, we're only taking orders above a certain size. Or they say, we need 24 hours to confirm pricing. This uncertainty is poison for a retail dealer. They can't sell you an ounce today at 65 if they don't know whether they can replace it tomorrow at 62 or 68. The unknown replacement cost forces them to build in a massive buffer. That buffer shows up as premium. Stage 3 is the replacement risk nightmare. Imagine a dealer sells you 1 ounce today for $65. They plan to replace that ounce tomorrow from their wholesaler at 62. But overnight, volatility spikes. The wholesaler stops quoting firm prices. Or the wholesaler raises their price to 67. Or the wholesaler institutes a minimum order of 1,000 ounces. The dealer just lost money on your single ounce sale. They can't replace the unit economically. This is why minimum orders appear. By forcing larger purchases, dealers ensure the transaction size justifies the hedging cost and the replacement risk. But here's what no one tells you. The real killer isn't inventory cost. It's settlement timing mismatch. When you buy online, you pay instantly. But the dealer doesn't receive metal from their supplier for days or weeks. During that gap, they are exposed. If spot moves $5 against them, they lose $5 per ounce on unhedged exposure. In calm markets, this risk is negligible. In volatile markets, it's catastrophic. So dealers do three things simultaneously. They raise minimums, they pause new orders, they extend delivery windows from 3 days to 6 weeks. All three actions reduce the volume of open exposure during the settlement gap. Now let's talk about the credit crunch that nobody sees. Dealers don't operate on cash. They operate on revolving credit facilities. A dealer has a $10 million credit line with a bank. They use that line to buy inventory from wholesalers. When they sell to customers, they repay the line. In normal times, the credit line turns over every week. The bank is happy. The dealer is happy. But when volatility hits, the bank gets nervous. They see metal prices swinging wildly. They see news about market dislocations. They see other banks tightening credit to commodity dealers. So they cut the dealer's line from 10 million to 6 million. Suddenly, the dealer has 4 million in stranded inventory and no room to borrow more. They stop buying new metal. They stop accepting new orders. They focus entirely on liquidating existing inventory to get under the new credit limit. This is why allocation mode appears. It's not about metal scarcity, it's about credit scarcity. The minimum order threshold triggers a behavioral cascade. Retail buyers see the restriction and panic. If dealers are limiting sales, metal must be scarce. Fear of missing out accelerates. Buyers who were considering 1 ounce now scramble to meet the 10-ounce minimum. The surge in large orders, ironically, makes the problem worse. Why? Because each large order increases the dealer's total unhedged exposure during settlement. The dealer has to wait longer to receive bulk metal from refiners. The time gap between customer payment and metal receipt expands. More exposure, higher risk. The dealer responds by pausing orders entirely or moving to allocation mode. Now the social feedback loop begins. Screenshots of sold-out inventory pages spread online. Forums explode with speculation. Is this a supply shock? A refinery halt? A government seizure? None of those. It's a hedging crisis, masquerading as a supply crisis. But the perception becomes the reality. A major forum influencer posts that dealers are rationing. Thousands of followers rush to competing dealers. Those dealers also hit their hedge capacity limits. Within hours, multiple dealers simultaneously restrict orders. The optics are terrible. It looks coordinated. It looks like a conspiracy, but it's not. It's parallel risk management hitting the same threshold at the same time. Let's pause here and examine the psychology of the buyer. When you see a minimum order restriction, your brain makes an instant calculation. Scarcity equals value. Restriction equals shortage. You don't think about hedging mechanics or settlement gaps. You think someone knows something you don't. You think you're late to the party. This triggers loss aversion, one of the most powerful forces in behavioral economics. The pain of missing out is twice as strong as the pleasure of gaining. So you act. You buy more than you planned. You pay a higher premium than you wanted. You accept longer delivery times than you'd normally tolerate. The dealer didn't manipulate you. Your own psychology did. Here's the next domino. Premium explosion. When dealers can't offer spot plus 3, they offer spot plus 15. But buyers assume premium reflects scarcity. High premium must mean no metal. So buyers rush to lock in orders before premiums go higher. This creates a self-fulfilling prophecy. More orders, more hedging stress, higher premiums. The premium curve detaches from fundamentals. Spot sits calmly at 62. But retail coins trade at 80. That $18 gap isn't profit margin. It's risk compensation for holding unhedged inventory in a violent market. And here's where it gets truly perverse. The high premium attracts sellers. Retail investors who bought at $30 see the premium and think, this is my exit. They contact dealers to sell back their coins. But dealers don't want to buy. Why? Because buying from retail means taking on more inventory during the exact moment when inventory is the problem. The dealer would have to hedge that new inventory. That costs margin. It increases exposure. So dealers drop their buyback prices. They normally buy at $2 under spot. Now they buy at $8 under spot. The spread between what they sell at and what they buy at is now $26. This infuriates sellers. They think the dealer is scamming them. But the dealer is just trying to survive the margin squeeze. The trap tightens further when delivery delays extend. A dealer quotes 6-week delivery. Buyers interpret this as a shortage. They pay up front and wait. But during those 6 weeks, spot could move $10 in either direction. The dealer is now holding customer cash but hasn't locked in their replacement cost. If spot rises $8, the dealer loses $8 per ounce. To avoid this, dealers add clauses. Price is subject to change. Orders may be canceled. Refunds may be issued. These clauses terrify buyers. They paid cash, but have no guarantee of delivery at the agreed price. Trust evaporates. Buyers flood social media with complaints. The perception of a broken system spreads faster than the actual mechanism behind it. Now let's talk about the wholesaler squeeze. Dealers aren't the only ones facing hedging hell. Wholesalers face it too. A wholesaler buys 1,000-ounce bars from refiners and breaks them down into smaller retail products. This process takes time. During that time, they're exposed to price moves. They hedge by shorting futures. But when margin requirements spike, the wholesaler faces the same cash crunch as the dealer. So the wholesaler stops accepting small orders. They tell dealers minimum order is $50,000, or they say we're only taking orders from established accounts, or they say delivery is now 8 weeks instead of 2. Each of these restrictions cascades down to the dealer. The dealer can't offer what the wholesaler won't provide. Now the funding squeeze hits. Dealers operate on credit. They borrow short-term to buy inventory. They sell inventory to repay the loan. In calm markets, this cycle turns every few days. In volatile markets, inventory doesn't move. Metal sits unsold. Loans come due. Banks see the volatility in tightened credit terms. A dealer's credit line drops from $10 million to $5 million overnight. The dealer now has $5 million in unsold inventory and no room to borrow more. They stop buying new metal. Wholesalers see order flow dry up. Refiners see demand pause. The entire chain freezes, not because metal is unavailable, but because the financial plumbing seized. Let's add another layer of complexity. Currency risk. Most wholesale transactions settle in US dollars, but many dealers operate in other currencies. A European dealer buys from a Swiss refiner in dollars, but sells to customers in euros. If the euro weakens against the dollar during the settlement gap, the dealer loses money even if metal prices stay flat. Normally, this risk is small. In volatile times, currency swings amplify metal swings. The dealer has to hedge both. Hedging costs double. Margins evaporate. The dealer restricts orders to reduce total exposure. What does this mean for the person trying to buy metal online? It means the website lie. The listing says in stock, but in stock doesn't mean deliverable at the listed price. It means conditionally available pending hedge confirmation and settlement finalization. The dealer isn't trying to scam you. They're trying not to bankrupt themselves by selling you an ounce they can't replace profitably. The premium you see today might not be the premium tomorrow. The delivery window you accept today might extend next week. This isn't a supply chain problem. This is a risk management problem bleeding into user experience. The second consequence is the two-tier market formation. Spot price becomes a reference ghost. It exists on screens, but not in reality. The real price is what you pay when metal actually changes hands. Spot trades at 62. Retail coins trade at 78. Wholesale bars trade at 65 for immediate wire transfer. Each tier reflects a different settlement speed and counterparty risk. The fastest settlement commands the highest premium. The slowest settlement offers the lowest price but the highest chance of cancellation or repricing. Buyers must choose between speed and cost. There is no longer a single silver price. There are multiple prices, stacked by urgency and credit quality. Now think about what this does to trust. For decades, the bullion market operated on a simple promise. Spot price is the price. Premium is transparent. Delivery is guaranteed. That promise is breaking. Buyers pay today for delivery in 6 weeks at a price that might change. Dealers reserve the right to cancel. Refunds may take weeks to process. This isn't how functional markets operate. This is how stressed markets operate. And stress breeds suspicion. Buyers think dealers are colluding. Dealers think buyers are unreasonable. Both sides are prisoners of a system that wasn't designed for this level of volatility. The third consequence is the trust collapse between dealer and buyer. Buyers see minimum orders and allocation as greed. Dealers see buyer complaints as ignorance of hedging mechanics. Neither side understands the other's incentive structure. The dealer isn't hoarding. They're hemorrhaging margin on every unhedged unit. The buyer isn't stupid. They're reacting rationally to opaque communication and sudden rule changes. The breakdown isn't malicious. It's structural. The system that worked at $20 silver doesn't scale to $60 silver with $5 daily swings. Here's the final consequence: the formation of gray markets. When official channels restrict access, unofficial channels emerge. Private sellers on forums offer coins at premiums lower than dealers. Why? Because they don't have hedging costs. They already own the metal outright. They can sell at spot plus 5 because they have no exposure to manage. Buyers flock to these private sales. But private sales carry risks, no guarantees, no recourse. Counterfeit risk. Sellers disappear. Packages never arrive. The buyer saved $3 per ounce in premium but lost the entire purchase to fraud. The gray market grows precisely because the official market became too expensive and too slow. This is how black markets are born. Not from prohibition, from friction, educational only, not financial advice. This isn't a story about metal running out. This is a story about risk becoming too expensive to manage. The hedge breaks, the spread widens, the minimum order appears, not because supply vanished, but because the financial scaffolding couldn't handle the volatility. When you see rationing, you're not seeing scarcity. You're seeing the dealer's balance sheet screaming for relief. Next time, we investigate the refinery freeze. When spot moves too fast, refiners stop quoting prices entirely. We'll map the replacement cost trap that turns production into a liability. We'll expose the doré bar backlog and why melting metal becomes unprofitable when futures go haywire. Watch for these signals: dealer premium divergence, delivery window extensions, margin requirement changes, wholesaler pause announcements, and refiner quote blackouts. The machine is showing cracks. We're just starting to see where it breaks first.